Hello everyone, let's continue our class. During the second half of the class, we will discuss the following issues. First one, bond features. Second, bond ratings. Third one, types of different bonds. Fourth one, the bond market and the bond price quotation. The fifth one is the inflation rate as well as interest rates. And the last one is term structure of interest rates. Now, before we go through those materials, let's take a look at the major difference between debt and equity. As we know, on any financial balance sheet, you will see two major sources of financing for any corporation, either from debt financing or equity financing. On the other side of the corporation, those are investors, both for bonds and for stocks. For debt, it represents a borrowing and a lending relationship between corporation and a bond investor. It's not an ownership interest. As debt holder, they do not have voting rights. And the interest paid by the corporation is tax deductible, which means it has tax benefits by paying interest to bondholders. And the fourth one is creditors have legal recourse if interest or principal payment are missed. And excess debt can lead to financial distress and bankruptcy. On the equity side, equity represents ownership interest of shareholders, and common shareholders have voting rights because they are the boss of the company. They have voting rights to elect the board of directors and deal with other strategic issues of corporation. And dividend paid on stock are not tax deductible. And paying dividend is not a liability of the firm. And the company has discretion on how much dividend and to pay based on the cash flow that they have. And the shareholder do not have legal recourse if dividends are missed or not declared. If company is 100% financed by equity, then there will be no possibility to go bankrupt. Now let's take a look at the feature of a bond. And a bond can be viewed as the deed of trust. And the provision describing the bond is called a bond indenture. And essentially speaking, the bond is a contract between issuing company and the bondholders. And in a typical bond contract, you will see the following provisions. The first one is the basic terms of the bond, which include the coupon rate, the principal payment, and the maturity date. And also in a bond contract, you will see total amount of bond that is issued. And for a typical bond, it should be specified as a secured or unsecured bond. And a secured bond normally will have collateral, which is safer for bond investor, and unsecured bond is more risky. And some bonds have sinking fund provision, which provides install payment for the principal. And the bond with sinking fund provision is safer than the bond doesn't have such provision. And for most corporate bonds, they are so-called call provisions. Call provisions. Call provisions refer to a mechanism where corporation can buy back bonds from bondholders when interest rates decline to a certain level. Remember that when interest rate declines, the value of bond will increase, and many corporations would like to call back the previous bonds so that they can issue new bonds at a lower interest rate. So call provision is a very common feature for many U.S. corporation bonds. And in the bond contract, you also see very detailed description of so-called protective covenants. And the protective covenants are things that a company should not do so that a bondholder's interest can be protected. For example, a bond contract may specify total amount of bonds that a company is going to issue in the future, because issuing more bonds will hurt interest of current bondholders. And more bonds means more risky financial structure for the corporation, and it will drive up the interest rates for the current bondholders. A bond can be classified as a registered bond or bearer bond. If the registered bond, then the name of bondholder will be registered with financial institutions, and a bearer bond doesn't have registration requirement. So the difference here is if you hold a registered bond and you lose the paper document of that bond, then in that case you're still safe because your name is registered within the system. But for bearer bond, if you lose the paper document, you may lose your investments. And in terms of securities, bonds can be classified as a collateral bonds or mortgage bonds or debenture. And both collateral bonds and mortgage bonds have collaterals. And collateral means assets or other financial securities that can be used to back up the principal payment and coupon payment within a bond. And collateral, the bond that has collateral is safer. And the mortgage bonds takes real property such as a house, a commercial property as a backup for future coupon and the principal payment. That is so-called a mortgage bond. Debenture, on the other hand, does not have any collateral. It's unsecured bond, therefore it's more risky. And the notes are referred to unsecured debt with original maturity less than 10 years. Bonds can also be classified as a senior bond or junior bond or subordinated bond. And the difference here is, in case of bankruptcy, senior bondholder will receive principal and a coupon payment before junior bond or subordinated bond holders do. And the bond characteristic refer to the major items that you see in your bond calculation. First one is coupon rate, second one is term to maturity, and the third one is principal payment. And for any investors, they will see coupon rate, but coupon rate has nothing to do with bond investment return. And as you see, bond can be classified into secured debt versus debenture, subordinate debt versus senior debt, a debt with sinking fund versus one without a callable bond, or the bond that has no callable bond. So those bonds should carry different coupon rates. Given all other things equal, which bond should have higher coupon? Secured debt versus debenture. And we know that secured bond is safer than debenture bond, and therefore the secured bond should carry a lower coupon than debenture bond, because the risk involved in debenture bond should be rewarded with higher coupons. Similarly, subordinated debenture should have higher coupon than senior debt because it's riskier. A bond with sinking fund should have a lower coupon compared to the one without sinking fund provision because it's safer. A callable bond should have higher coupon than non-callable bond because callable bond give corporation a privilege or a call option to call back the bond when interest rate is lower. Therefore, that kind of bond give benefits to corporation, therefore the coupon should be higher for bond investors. Now, let's take a look at bond ratings. Bond rating is not a great issue for U.S. government bonds because U.S. government bonds have one of the highest credit rating. But for corporation bonds, it's very important to identify its credit quality. And we have two major credit rating agencies, S&P Company and Moody's. Both companies provide credit rating services to bond investors. And they analyze the safetyness of the bond, the financial situation of the firm, and give independent evaluation on the quality of those bonds. And the credit rating reflect the evaluation results for a specific bond issues. And highly graded bonds are bonds that carries higher credit ratings, such as AAA, AA, or single A. from S&P, and the Moody's use different system, but very similar to those used in S&P 500, S&P company. And a triple A rated bond by S&P company is equivalent to AAA bond issued by Moody's company. And both high-graded bond and medium-graded bond are considered as investment-graded bond, and it's relatively safer for investor to invest in because the possibility for company to have default on its coupon payment and principal is pretty small. It's pretty small. So when investor investing in those highly graded bond, they don't need to worry a lot in terms of future coupon payment and principal payment. But for speculative graded bondholder need to worry a lot, and those bonds have relatively poor quality, and the company may in distressed situation, they may not be able to pay back coupons and principals as they promised. And a typical speculative graded bond carries S&P credit rating of BB, single B, single C, double C, or triple C. And the triple C is one of the lowest rating that issued by S&P company, and Moody does similar thing. And the bond that has very low grade, is considered as so-called junk bond. So the question here is, if bond is not safe, then why investors are purchasing those bonds? Well, remember, there is a risk-return trade-off. When a bond carries more risk, the investor should be rewarded with higher return. And on Wall Street, there's another nickname for junk bond, which is high-yield bond. So look, poor quality and the low credit rating goes with higher return. People like safe investment, but you have to withstand low return. So you always see very clear risk-return trade-off not only on the stock market but also on the bond market. Now let's look at some major types of bonds. And in our country, bonds can be issued by governments, can be issued by corporations, right? And government bonds are bonds issued by federal governments or local governments. If it's issued by local government, we call that as municipal bonds. And across country, we have more than 10,000 issues of municipal bonds. And municipal bonds can be issued by state governments such as Tennessee, the state of Tennessee, state of Georgia, state of California, so on and so forth. It can also be issued by county government as well as city governments. And most municipal bonds have so-called a tax-exempt provision, which means tax received by bondholder is tax-exempt at the federal level. For federal government issued bonds, there are three different types. The first one is Treasury bill, and the second one is notes. The third one is bond. The difference here is term to maturity. If term to maturity is less than 1 year, we call it as T-bills or Treasury bills. And the T-bills are mostly discounted bond or zero coupon bond. It carries no coupons. If term to maturity is less than 10 years but greater than 1 year, we call those as Treasury notes. And the Treasury notes are typical coupon bonds. If a government issued bond has term to maturity greater than 10 years, then we call it as Treasury bonds, and the maturity is greater than 10 years. Treasury bonds are most actively traded bonds on the market. And here's an example for you to see the benefit of tax exemption status for municipal bonds. And for most municipal bonds, the interests are tax exempt. Which means as bondholder you will receive more in after-tax interest income. But the market is a fair place. to evaluate municipal bonds and other equivalent bonds. Right? Let's say you have a bond issued by Tennessee state government and a corporate bond. Then those two bonds have similar credit rating. Then you would see that municipal bond issued by Tennessee government will have lower yield to maturity, right? Because the market is fair place to consider the effect of tax exemption. On the market, many investors are investing in so-called zero coupon bonds. Zero coupon bonds are bonds that carries no coupon. And you may ask, why would investor invest in zero coupon bonds? Because the major source of income for bond investor are coupons. And the reason why investing in zero coupon bond because zero coupon bond price is not equal to its principal value. And typically, a zero coupon bond will be sold at a deep discounted price. Right? For example, let's say you buy a 10-year zero coupon bond, a zero coupon U.S. government bond with principal payment of $1,000, and this is the 5-year zero coupon bond. Guess what? The price would be much lower than $1,000. And zero coupon bonds have very unique risk-return trade-off than the coupon bonds. And zero coupon bond carries highest interest rate risk because there's no offsetting force from reinvestment risk side, right? Because it does not have coupon payments. Floating rate bond refers to bond that has rates that can be adjusted based on certain indexes. And a very common case for floating rate bond is U.S. Treasury inflation adjusted inflation protective security. And for that bond, the coupon rate and the principal payment can be adjusted based on inflation rate. If inflation rate is higher, then bond investor will receive more for its coupon payments and the principal. And if inflation is low, then that number will be adjusted downwards. So essentially speaking, floating rate bond protect bond investor from interest rate risk. So floating rate bond is a great vehicle for investors to manage interest rate risk for their bond investment. And other bond types include structured bond, convertible bond, the bond with puttable provision, and many other provision can also be added into bond. And bond market is a truly very dynamic place for bond investor to find a very unique risk-return trade-offs. And also, bond market contains a lot of financial innovations. For example, convertible bond. Convertible bond is bond that can be converted back into certain amount of stocks given certain conditions. And in this case, the bond price carries two components. The first one is the bond value without convertible provision, and the other part is a call option on stock. And a puttable bond actually carries two components in its value. The first one is the bond value with no puttable provision, and the other one is the put option value of the stock. Bonds are primarily traded over the counter across the country, and on the over-the-counter market, bond investors essentially deal with security dealers which connect electronically across the country on that over-the-counter market. And the bond market trades a large amount of bond issues, but trading volumes are pretty thin for any single issues. And here's a surprise to you guys. On the bond market, there are more than 1 million. There are more 1 million bond issues existing, compared to 3,000 stocks tradable on New York Stock Exchange, another 3,000 on NASDAQ. Look, there's a large amount of bond issues available on the market. But most bonds are not actively traded because bond holders Most bond holders would like to hold the bond until the maturity. They do not trade the bond a lot. And the only exemption here is Treasury securities. T-bills, T-notes, and T-bonds are frequently traded. And those are most liquid assets, not only on the bond market, but also on the entire financial market. Now let's take a look at a U.S. Treasury notes and bonds price quotation. And this is from Wall Street Journal. And there are 6 columns for many different U.S. Treasury notes and bonds. And the first column showed you the maturity date. For example, the first one will mature in November 30th of year 2012. And the last one will mature on November 15th of year 2041. And the second column showed you coupon rate, and those numbers are in percentage. You see low numbers around 1%, 2%, 3%, and the high numbers 8%, 7%, 10%. And here, investor would like to invest in bond with higher coupon rate, let's say 10%, 8%. But look, the coupon rate has nothing to do with your bond investment return. If you care about the bond investment return, then you need to look at the last column, the ask the yield. That is yield to maturity based on ask price. Right? If you invest in shorter term Treasury bonds, then you will earn lower yield. If you invest in longer term bond, such as the bond that will mature in year 2040, year 2041, then the yield is relatively higher. So in the current environment, you would expect as Treasury bond holders, you would reasonably expect to receive return from basically 0 up to 3%. If you invest in short-term T-bills, then your return is going to be basically 0. For example, the first one only offer you 0.06% return. It's virtually 0. And if you invest in 10-year bond or 10-year notes, then your return would be something around 2 to 3%. And if you invest in long-term bond, long-term T-bonds, such as 20-year, 30-year bond, then your return should be something around 3%. And here's more information about Treasury security quotation on the market, and notice that there is bid and ask price, and bid ask prices are posted by Treasury security dealers. And if you want to buy a bond from dealer, you take ask price, which is slightly higher than bid price. If you want to sell a bond to Treasury security dealers, you take bid price because it's lower. The difference bid-ask spread is revenue for security dealers to offer security dealing services. And here's a more example for U.S. Treasury bond quotation. And when bond dealers offer quotation, often they offer you 2 different types of quotation. One is clean price, the other one is dirty price or full price. So what's the difference? The clean price is a price that is net of accrued interest. Let's say you invest in a 10-year T-notes in the middle of the year, and the first semi-annual coupon has been paid, but the next one has not been paid. So the clean price will exclude the value of the accrued interest from your calculation. But if you wanted to consider the value of accrued interest, then you needed to look at the dirty price or full price, because full price includes accrued interest. Now let's move to the next issue, which is the relationship between inflation and interest rate. Right? And if you receive a rate of return of 5% this year, will you be happy with your investment performance? The answer could be yes or no. Depends on the inflation. If inflation is higher than 5%, then 5% nominal return means you are losing money. You are losing purchasing power for your investment. But if your return is higher than inflation, then you would say, hey, you are in good shape, because after considering the losing of purchasing power, you still make net gains for your investment. So when we look at the interest rate, we need to consider inflation, because the real rate return will be eaten up by higher inflation. The Fisher effect formula showed you the relationship between inflation rate and interest rate. The big R here is nominal rate, or nominal interest rate, or nominal investment return, and R is the real rate of return, and H is inflation rate. And we can use the first equation to calculate real rate of return of your investments, and in approximation, your nominal return equals inflation rate plus your real rate of return. Let's use again an example to see how can we deal with inflation for your investment return. Let's say if we require 10% real return and we expect inflation to be 8%, what would be the nominal return? Well, there are two ways for you to fix the problem. The easiest way is you put two numbers together, 10% real rate of return plus 8% inflation. That will give you 18% of nominal rate of return. A more accurate way is to use 1 plus 10% real rate of return times 1 plus 8% of expected inflation rate, or minus 1, to get 18.8% of the nominal rate of return. And both methods are acceptable, and although there's some difference, but difference supposed to be very small. Before we conclude this chapter, let's take a look at the very last issue of interest rate and bond evaluation, that is term structure of interest rate. What is term structure? Term structure showed us the relationship between term to maturity and year to maturity of a bond, given all other things equal. And the term structure of interest rate can be described in a graphic expression called yield curve. So when you see yield curve, it's essentially the same thing as term structure of the inflation rate. Now let's take a look at a typical yield curve. And this yield curve, or term structure term structure of interest rate, showed us the relationship between time to maturity and interest rate. And here you see a upsloping yield curve, which means the interest rate is higher for longer term bond than shorter term bond. And within this term structure, you see three major components. First one is real rate of return. The second one is inflation premium. And the third one is interest rate premium. And here you see why longer term bond carries higher interest rate, because for longer term bond investors are facing higher inflation risk, and also they are facing higher interest rate risk. Therefore, those risks need to be compensated or rewarded by the market. And you would say, hey, since actual risk associated with the long-term bond should be compensated with a higher return, therefore we should always have upsloping yield curve or upsloping term structure. But that's not always the case. Sometimes you will see downward sloping yield curve. Why is that? And here you see why. Let's say real rate of return are the same for both short-term bonds and long-term bonds, but inflation premium could be much smaller for long-term bond than short-term bond. That explains why term structure can be downward sloping, even though interest rate risk premium is always greater for long-term bond than shorter-term bond. And here's an example for Treasury yield curve. Then you see two curves, one purple curve and one blue curve, and those are yield curve, different dates. And the blue yield curve is the current yield curve, and the purple curve is the curve 1 year ago. As you see, yield curve doesn't stay the same over time. They changes. And between year 2011 and the year 2012, you see that the yield curve level has been declined. While short-term rates are essentially the same, but for long-term rates, it has been declined. For example, for 30-year T-bond, the yield was 4% in year 2011, but in year 2012 it declines to 3%. Right? And for 10-year bond, it declined from 3.5% to around 2%. So yield curve, the shape of yield curve often changes based on the macroeconomic situations and the Federal Reserve's monetary policies. Right? And here are quiz questions that you needed to look at before you go ahead to practice those homework questions. How do you find a value of bond, and why do bond price change? What is bond indenture, and what are some of the important features? What are bond ratings? Why they are important? How does inflation affect interest rates? What is term structure of the interest rates? Or what is the yield curve? In the lesson, what factors determine the unique return on bonds? And this is a pretty long chapter, although and also it's a very important chapter. And we learn a lot of terminologies and some new mechanisms. I expect you to spend a little bit more time reviewing this chapter by reading the textbook and practice those homework questions. Once again, this is Kevin Zhao, your finance professor at MTSU. It's my pleasure to work with you guys, and I will see you in next lecture. Thank you.